thinking that you got only limited liability and hence profit will be there, I think you will be quite mistaken if you hold the position. Of course, for those who are very adept in technical analysis and those who are able to switch over the positions quite fast, whether on intraday basis or whether on a position trading basis, yes, probably you can afford to deal with buying side of options also, because you will be getting it out before the option decays considerably. But suppose if you are a passive investor in the sense that you want to do the trade once in a week and probably leave it to the market, and end of the week you would like that position to be closed, because there are different personality traits of different traders have got different personality traits. The most important thing is that most of them don't want to see many losing trades, because it is a psychological drain. Okay, so most of them would like to have as many winning trades as possible. So that is one important consideration for most of the traders. Now the winning trades that probably you will be looking at it is something like 80-20, right? 80-20 or 90-10 generally is what normally you will prefer to be on the winning side. When I say 80-20, I'm saying that suppose 50 weeks or 52 weeks in a year, if you trade, you would like at least 45 weeks to be profitable and 4 or 5 weeks to go at a loss. Okay, so if that is the ratio, then you will be quite happy to do such trade. But when you do such trades, normally the profits will be limited. But what is the investment that you are going to put? So what are the most important points that normally you will have? First of all is the number of winning trades that you would like to have winning trades. Okay. So this is the most important thing for a lot of people. What is the number of winning trades that you would like to have? Okay. Now, if this is going to be, now the answer is going to be for this is, let us say 85% chance. Okay. Then definitely you should be happy to take such trades. Second is that what is the investment required? So this is also very important. Investment required is also very, very important, right? What is the investment that is required? Now, if the investment for this number of percentage of trades, just look at something like 30,000. 30,000 rupees is the investment that you may require for this. Investment required is 30,000 rupees, because you know that this amount is not a big amount. Investment required 30,000 rupees is not that big amount, right? So you may not, even for smaller traders, probably you can enter such trades. So the investment required, because right now the quantity has been downsized from 75 to 50. Now Nifty quantity you may be aware, now you have got only 50 is the 50 is the equal to one contract. 50 is equal to one contract now as far as Nifty is concerned. So now because of this, the margin requirement has gone down. Now for most of you will be usually enjoying a lot of exposure facilities. The entire worry is that how do we position ourselves in a situation from August where almost 100% of the upfront margin is required even for intraday trading. Okay, it's almost like a position trade. So if you do one Nifty, then in that case the futures require something like 1.1 lakhs is what we have already highlighted. That 1.1 lakhs is the investment that is required for one Nifty futures, right? So that is a slightly bigger amount. So what you would like to do is that you would like to go for a much smaller amount, which could be even less than 30,000 for one contract. So probably, let us say, I tell you that probably the investment that may be required is something like, say, 25,000 rupees. Okay. So you may require something like only 1/4 of the margin of the futures that may be required for this. Okay. So what is that required? That you invest 25,000 over a period of time. What is the return on investment that you are getting? So that is the most important thing. Is that now you've got winning trades, which is almost 85%. Investment required for doing one particular spread contract trade. This is a spread contract trade. So that is required is 25,000 rupees only right now. Okay. And 50 units is one contract. So what is the return on investment that is there? So you will be more looking towards return on investment, right? So what is the return on investment? Okay. Now return on investment over a period of time, this particular strategy can also produce something like 100% per annum. I'm not trying to tease you with all this thing, but I'm not also trying to tell you that because it's such a product, then you put all your money into this trade. I'm not saying that. What I'm saying is this is the past statistics that we have seen in our working. Okay. Now, when you get such a return on investment of 100% per annum, suppose if you want to match the spot market contract performance in the sense, what I'm saying is the let us say the market now it's 15,000, say 700. Now after 1 year, let us say you are looking at something like 16,200 or 16,500, right? After 1 year, say 800 points, something like 5-6% return. That's not a great amount, but market has run considerably in the last 1 year or so. So we cannot keep on expecting great results, compounded results from here. Probably next year could be a little bit of slowdown as far as the gain percentage is concerned. Let us say you got 8%, you're getting something like that. Then in that case, there's a spot contract then. So when you do for this particular type of contract, this type of spread contract which you are going to explain to you now, probably you may need something like 2 lots or 3 lots. Okay, 3 lots may be required to match a spot contract type of trade, and 2 contracts may be required to match a futures type of trade. Now, when we talk about 2 contracts also, the investment required could be something like 50,000 as against something like a 1 lakh and odd, which is there for the futures. Okay, but it is going to produce 85% winning trades. So that is an advantage. Second thing is that when you require only 50% of the futures amount or 1/4 of the futures amount, then the return on investment is going to be even much more, much higher, almost 3 times or 4 times of what the futures return is going to be. And in the case of compared to spot market contract performance, probably you may require 3 such contracts of the spread trade that we are now going to highlight. Now, what is this spread trade? What is the strike that we are going to take? Okay. Now, one is that we have already highlighted that the margins are not required in case if you are looking at, see, now we have already highlighted that if you are only a buyer of an option, okay, buyer of option, you may not require any margin, right? No margin for this. No margin. If you are a buyer of an option, you don't require a margin, right? So you don't require, if you are a buyer of an option, you don't require a margin, okay? But if you are only a seller, you require a margin. But instead of that, if you are doing an edged contract right now, that is, you are doing a spread contract. So what do you mean by spread contract? So spread contract. So spread contract means you got 2 legs. One leg, let us say, you are selling 15,500 put. Another leg is, say, 15,300 put. So this is a spread contract. That is, you are buy long or short in one and long or short in the another contract. So this is called a spread. When there is more than one strike involved, then that is called a spread contract. Now 15,500 and 15,300. Now I will tell you why we have chosen this 15,500 and 15,300 for illustration purposes. But just take it for me that no, if you do a contract like this involving 2 legs, then it is called a spread contract. Now we have taken put contract. First of all, we have not taken a call contract for the time being. We have taken only a put contract. Why do we take the put contract? Now when you are a seller of a put, now we have already illustrated before in many webinars that if you are a seller of a put, it's like buying a futures, because if you are a seller of a, what are the possibilities if you want to be on the long side of the market? Either you have to be a buyer of futures or in the cash market, or you have to be a buyer of a call, or you have to be a seller of a put. Okay. So a seller of a put, in the case of a downside gain, he is slightly better off than being long in the cash or long in the futures, because to the extent he receives the premium, he or she receives the premium, a seller of a put is slightly better off compared to the futures owner or the cash market owner to the extent of premium that he or she has received. But if the market climbs steeply, then in that case, definitely a seller of a put doesn't participate in the upside possibility to the extent the market rallies, because the participation is limited only to the premium that he or she has gathered, right? So to that extent, a big climbing market, the selling put is not the same like buying a futures or buying in the cash market. But over the period of time, market adjusts itself. Now, let us say a couple of weeks, it rallied considerably to 15,800, 900 levels. But if you see a lot of consolidation that is taking place, now you look at the chart. See, if we look at it, the last 2-3 weeks, now if you put a weekly chart, let me put a weekly chart. See, in the last 4 weeks, this is the last 3-4 weeks, there has been no big rally at all, right? There's no big rally. So, if only in this particular place, probably a seller of put would not have participated to the extent of an upside. But in this particular case, the futures, there's not much of a gain, but the seller of the put keeps making money here. Okay. So because of that, all these things get averaged over a period of time. So the seller of put is not at any great distinct disadvantage over a period of time. See, if you take only a limited period of time, like last year to this year, April to April, then there has been such a steep climb in the market. And it's almost from 8,500 levels or so. Today we are talking about 15,500 plus 7,000 points. And in this 12 to 15 months, whatever period, even if you have collected monthly premium to the extent of an average of 300 rupees per month premium, even if you collected, probably the return you would have collected something like 4,500 rupees. And in those 4,500 rupees, probably there could have been periods where market fell down, market went up. So you need to really calculate how much of gain you would have made in all those this one. So over a period of time, probably the return right now in this last 1 year, in the case of a futures, well, definitely, or in the case of a spot market, definitely the rally will be much higher in the case of in such a steep climb. But that is not going to be a repetitive one. So over a period of 2 years, probably you will have the seller of the put also will be averaging it out. So for a minute, I am not suggesting that you should be a seller of a put. I am only talking about seller of a spread option. The reason why we are talking about is we are trying to position ourselves where we get maximum number of winning trades, because that is going to be a psychological advantage for you. So now let us come to the point that why now the reason that we have said is that you should go for a sell put spread strategy, not a sell call strategy, because selling put is like buying a futures or buying the cash market. To that extent, you are going to be a seller of a put and seller of why you are choosing a spread instead of a seller of a put itself. Okay. Now that question can be answered in terms of margin money, because if you are a seller of a put, then probably you will also be paying as much of margin as the futures, maybe a little bit less if you take a distance strike, but you will end up definitely paying a good amount of margin money, and also MTMs also. So a seller of a plain put also may have to fork more amount of margin money, and also may have to fork out a lot of amount of MTM in case if it arises. And also third thing is that you see what happens. The worst part for any trader is sometimes the market will fall vertically down even 200, 250 points in a single day. It will confuse you, and by the time you try to react, it will also climb up. It will climb up, okay, and probably you will be kicking yourself, saying that why did you remove your position, okay. Now those problems of where probably you're getting confused, trying to take off position, reintroducing your position, those things can be solved by going for a put spread, because you are quite confident that there are some important levels of support that is going to come. But when it temporarily falls to that level, could be an intraday or intra-week position, you really get confused, and probably out of panic you remove your position, but only to see the market jumping even within a few seconds and minutes from that particular level. Now I'll tell you why. Now this, let us say you go to the daily levels. See, now if you see there are a lot of breakouts that are generally given. See here, this particular if you are trading as per the normal Dow type of theory of chart. Now this low was broken and it came down here. Okay. and of course we are not seeing any particular fall from this level. But if you it will probably, this 15,450 levels might have been a good support, okay, but when it falls down to this particular level steeply on this particular one single day, then probably you will be worried whether the fall this time is going to be much more, and most so you will also be worried about whether it is going to lead to the type of crash that we have that we see once in a decade. So that will always be at the back of your mind. So in those day, probably at some stage you would have put a stop loss only to see the market again climbing up, right? So those confusion or probably the position shakeout. The position shakeout or shaking of weak positions. See, most of the small traders or most of the traders generally are weak hands. They say that weak hands in the sense that they are not able to tolerate some sort of a loss. They are also not able to withstand the pain of seeing the market going up and down. Resources wise, everywhere they are in short of the market requirement or movement. So in that particular case, you get yourself out of the position, okay, but only to see the market going up again. So that problem is going to be solved by putting a spread strategy, because if you put a spread strategy, then you know that it is like a stop loss. Suppose let us say you have sold a 15,500 put, and your 15,300 put also you have bought, okay. So you know that at any point of time the maximum loss is going to be 200 and you have collected some premium. So the loss is going to be some 150, 160 or whatever it is for that particular week, and so you are not going to be too bothered about that, right? So you are not going to be too bothered about this one. So you will wait a little patiently, and once you wait patiently, probably you can see the market swinging and coming back to the normal levels. So to that extent, the spread eases your tension, okay. So that's the reason why we go for a spread. Second reason is that we told you about the margin. Now the margin for this particular spread trade that we have just said, see, is equal to, normally what they will do is they will collect what is called a span margin plus an exposure margin. Now when you do a sell put strategy like this, now in this case let us say you are going for a sell 15,500 put and you are buying a 15,300 put, okay. So let us say in this particular strategy where you sell a 15,500 put and you are buying a 15,300 put. So the maximum amount of loss is how much? It's going to be 200 rupees, right? So 200 into 50, that is one contract. Now contract is 50. So 200 into 50 is going to be 10,000 rupees, right? So the 10,000 rupees is what they will collect, okay? 10,000 rupees, because that's the maximum loss that you are likely to have. So they will collect this 10,000 rupees. And exposure margin, they put 2% of the contract value, 2% of the contract value, and 2% of the present contract value is comes around 15,000 rupees, right? Because it is around 7,50,000, so around 15,500, 15,800. So in this particular case, what you will have is something like, then you also sold some premium is there. So probably this particular strategy will entail you to something like 25,000 to 23,000 rupees, 23, 25, it will not exceed 25. That's all. So that's all your amount, okay. So for this 25,000 rupees, let us say I tell you this 15,500 put and buy 15,300 put. This week, yesterday, this trade was done yesterday when the spot was 15,000, approximately 15,680 or so. I think it was done. Let us say this trade was done. This was done when the spot was approximately 15,680, okay. And why this strike was chosen, I will come to that. Now, when this is being done, the premium that we have collected for the difference between 15,500 and 15,300 is approximately 25 rupees. That is for the spread. We have collected rupees 25. Rupees 25. Of course, into 50, right? So into 50, say 1,250 rupees. We have collected something like, for this spread 15,500, 15,000, we have collected 25 rupees. 25 into 50, we have collected something like 1,250 rupees, okay. Now 1,250 rupees, if you are doing something like, if there is no loss, this is only a weekly strategy, right? This is only a weekly strategy. Assuming the market does not go below 15,500, at the end of this week, you are retaining the 1,250 rupees. Let us say you are retaining this 1,250 rupees. If you are retaining this 1,250, what is the return on investment you are putting? You have put 25,000 rupees, right? So the capital is capital is 25,000. Let us say you have got the entire profit of 1,250 rupees, entire profit is there with you. So it is 1,250 divided by 25,000, right? So you are getting something like 5% per week. Per week. This is 5% per week, right? So just imagine the profit that you will make. So for the return on investment is quite high as long as you don't make a loss. As long as you don't make a loss. Now I told you that there is a chance that probably you will have out of 50 weeks, you will have only 5 weeks where probably it can give you problem. Between now we are talking about 15,300, 15,500 and 15,300. So what is the maximum loss? The maximum loss that you are going to have is 200 rupees, right? 200 rupees is the maximum loss. Minus 25 rupees, you are already going to get the premium. So your maximum loss is going to be 175. But normally, not in all those 5 weeks where I am talking about the loss, you will get a loss which is equivalent to that entire amount. Okay, 175, that is not going to be your thing. Maybe, it will be 15,500 means, generally it may have a fall to 15,400, 15,350, even those weeks where you are making a loss. So the loss in this case of 200 can be approximately something like a loss of say 125 rupees or so. The 200 rupees which I am talking about a loss minus 170 rupees can have a loss of something like 100 rupees or so net of after the premium that you have paid. So 5 weeks you will have problem which is 100 rupees. So 100 into 5, 100 into 5 weeks, okay, into 50. Okay. So how much? You are getting this is 250 into 100, right? 250, you are getting 500 into 50 to 25,000 rupees. So the maximum loss in that year, total loss, cumulative loss for the year is going to be this much. Okay, 25,000 rupees is possibly is the maximum in the cumulative loss that can come. But the profit that you are going to get every week you are going to get is something like 1,250 rupees. 1,250 rupees. 1,250 into remaining 45 weeks. Suppose let us say 1,250 into remaining weeks approximately into 45. Okay. So this is going to give us 56,250. Okay, 56,250. So the net that we are going to get is something like net profit is going to be 31,500. Less minus, let us say, I tell you maybe another 5,000-6,000 rupees goes in cost. Cost is, let us say, in this 31,500, let us say the cost goes to be 5,000 rupees. So your net profit is going to be 26,500. What is your investment? Investment is 25,000. So what is the return on investment? Is going to be more than 100% per annum. 100% per annum. You are not going to get 100% per annum even if the market is going to rally. I think you are not going to get 100% per annum in cash market or in futures market. So your return is going to be more than 100% per annum. Okay. So this is the one of the most successful trade that you can think, and you can do this whether it's going to be Nifty or it's going to be in Bank Nifty or it is going to be in any other stocks. Of course, in stocks we don't have a weekly. So why we have chosen weekly? Why? See, there are two questions that you need to ask. Why have we chosen weekly? Why we have not chosen monthly? That is one. And why we have chosen these strikes? So this is the most important aspects of this trade. One, the reason why we have chosen a weekly strategy compared to monthly strategy is every week that you get a premium. In the case of a sell option, every week that you get a premium, the sum of all these things is going to be greater than the monthly premium. It's going to be the monthly premium. For example, let us say this particular month, this week, the premium was approximately for 15,700 call or put when the market was trading close to 15,680. It was something like 95 rupees or 100 rupees, approximately, let us say 100 rupees. So every week you sell an ATM strike. Okay, you will get, let us say, in the present scheme of volatility, you may get 100 rupees for an ATM premium. So 100 into 4, you're going to get 400 rupees. But whereas in the case of month, for the full month if you sell, you will get only 200 rupees. So when you by choosing a weekly option every way, you are going to get something like double the amount of monthly premium. So every week that you are going to sell, you will have a total cumulative premium for that month, which will be greater than the monthly premium. That is the reason why we have chosen a weekly premium. So it could be for Bank Nifty, it could be for Nifty. In the case of stocks, we have only a monthly option. So the only thing that we can do is to do for a monthly option there. So normally speaking, we have already explained that the option premium is not linear. It's not linear. That no, every week you pay 100, month you get 400. It's not there. It's a curvilinear thing. So every week that you pay 100 will translate only into 200 rupees for the entire month also. Okay. So every week selling will give you a total cumulative premium which will be more than the monthly premium. So that is the reason why we are going in for a weekly option. Second thing is, of course, you got a good amount of liquidity. Then most important, I've told you what is the other important aspect. One is, of course, you get more amount of winning trades, the return on investment. Third is that you are doing like a weekly SIP type of investment. Now see, what are you doing? On Thursday at 3:15 p.m. you are executing the trade. Next Thursday at 3:15 it gets closed and you initiate the next trade. So in between you are free to, of course, whatever you want to do as far as that particular trade is concerned. In between we will come to that later on in case if you want to do. But that is saying you want to be a passive person. That is, you don't want to really take the trade, do this trade, do that. You don't want to do that. You just want to be just ensure that you just want to be a very passive investor. So this Thursday I have done. Okay, now I'm not doing anything else. Next Thursday I will do the trade again. So weekly, only once you are indulging yourself in a trade. So to that extent your time is completely freed. Okay, so you can you make your money work without your involvement in any big manner. Okay, so this is like an SIP type of scheme. Second thing is that you have chosen one asset. You can also choose some other assets and concentrate on something else. For example, you could do Bank Nifty one trade, or you could do probably a stock for a monthly option, or in currency. Probably you may also be looking at commodities market. Of course, there is no option there, but you want to trade. So you are freeing yourself from this and looking at something else. So you are making Nifty work now with this money finished. Okay, I will not concentrate anymore on Nifty. Bank Nifty, I have done this, I have finished. So I will not bother about intraday volatility and all. See, the reason, big advantage is that today also the market came down a little bit. It will not create any panic to you. Okay, because you know that you have put a spread trade. One. Second thing, there is a very reasonable chance that there could be some support from where it can go up. But we are not even estimating the support. The reason why we have chosen a 15,500, 500 for the sell side, very simple thing. See, normally, every day. So what is volatility? Now, I'll just explain to you the basic thing of how this works. See, volatility is nothing but up and down movement, right? Up and down movement. Now, let us say, generally speaking, nowadays, what is it that you see compared to yesterday, today? Okay, like that, how many points that you see normally nowadays, close to close basis? I'm not talking about total this one, average, on a close to close basis. On a close to close basis, 100 points, either the market closes within 100 points of previous day close. If it is 15,720, 30 today, it could be 15,630 tomorrow, or it could be 15,830. Okay, the next day it could be something like 15,830. So it can be like that, right? It's not going to be much more generally speaking, 80-85% of the time it will be confined. Why? It has nothing to. It has got to do with the volatility. Now, market makers believe that this volatility per day is going to be only this. That is how the option is priced. That is how the option is priced. So generally speaking, the probability that it will exceed 2 times of the option premium price is going to be only 15%. It's going to be only 15%. That is, if the option premium price, let us say right now we don't have a daily option, but on Wednesday you can look at a Thursday option price. On Wednesday you can find out what is the Thursday option price, right? That is a single day options, right? So what is the nowadays next Wednesday you can see what will be Thursday's price. Now if you look at the Nifty, normally nowadays it's now coming closer to 40 rupees or so. That is, next day it could be 40 to 50 rupees is the ATM option. ATM option I'm saying is, if the market will close to 15,800, I'm talking about 15,800 call or put, or an average of that is something like 40 rupees these days, or 40 or 50 rupees. So that means, what is that twice that option price movement? 40 into 2 or 40 into 50 into 2, whatever the per day option price, it comes to 80 rupees. So that means the market is expected to be either 80 rupees on the downside. We do not know the direction, because let us not worry about the which way it's going to move. Either it's going to go on the upside or it's going to the downside. But generally speaking, is that the market does not want to give a free lunch for you. It doesn't want to give. That means, if it is going to move much above that consistently, everybody will just buy a straddle. Now, just tell me that, no, just think like that. No, if the market movement is going to be very easily above the option price, twice the option price, or a straddle option thing, like call and put. If it is going to be a call and put, which is you're buying there, and if you feel that the market is going to be more than that, okay, then in that case, probably everybody, and it's going to happen daily, and everybody is going to make money, right? So that means you will be buying a straddle on a week before day, and 80 rupees, so 80 rupees, 90 rupees, 100 rupees, you're going to, even 10 rupees, 20 rupees you're going to make, you're going to get a free, you're going to get it easily. Similarly, if you buy for a week also, let us say you're paying 100 rupees so for the call and 100 rupees for the put, and yesterday the market was 15,700. So you're going to get very easily below 15.5 or above 15.9. Okay, if you're going to get that easily, then in that case you will do. But when we see this prices, as right now, see this option price in a weekly, the volatility has started to come down. Previously, a couple of months before, the volatility was so high that even a weekly option, ATM option, was something like 195 rupees or 190, 195 rupees. Then it started to come down to 150. Then it came down to 125. Then it came down to 112. Now it has even dropped below 100. So the volatility is now very, very low. If you see the last 4 weeks, volatility has come down very significantly. Okay, so that's why we are seeing very, very small option premium right now. One of those lowest option premiums over a period of time that we have seen is prevailing right now, which is good in the sense that the market seems to be quite happy with the market condition, and it doesn't expect any big fall to happen. So now, so that means twice that volatility is an unlikely thing to happen. Once something happens, then the volatility will expand, we will go to adjust it. That's why we are doing every week option. Suppose in this week we are going to fail, next week automatically the expanded option volatility is going to give us a higher option premium. It's going to give us, reward us with some higher option premium, right? So right now we are more this one on a theoretical basis. The price closing at and or above twice the option price, or twice the option price for that particular period is an unlikely thing. That means yesterday the market was close to 15,700, okay, and the call option and put option price were all closing at 97, 98 and 100 rupees, okay. So what is that 197 or 100 into 2 is 200 rupees. Market was trading close to 15,700. So 15,700 minus 200, 15,500. So we don't expect the close, that is next Thursday close, to be below 15,500. Next thing to close below 15,500. So what have we done? We have taken a 15,500 sell option. Okay. Now the reason why we have chosen a 15,300 to buy is that I told you margin money saving. One. Second thing is I want to have a free sleep, because though the general expectation it should not fall down, there is always a 15% chance that the market can crash below that, and once it crashes, then in that case, no, we do not know how much points it will fall, because sometimes there can be a black swan event which can take the market lower considerably. So we don't want to get caught in such a situation. So we want to do a buy side, because of which we are sacrificing a little bit of a premium and thereby on the return. Fine, but even if the return is going to come down a little bit, it is fine as long as we are going to get ourselves protected and also entail a lower amount of margin money that is there. So that is the reason why we have gone for a buy side, which is 15,300. The distance that we have maintained the same, like 15.7, 15.5, 200 rupees different. So 15.5 to 15.3. So that is what we have done, because statistically, of course, if you see, normally the market falling more than 2% below the weekly price is only 15%. Okay, over a period of time, any last 2015 to now, it is only not more than 2%. So the fall below 2% has been generally only 10 to 15% of the time. That means in 50 weeks, it could be 4-5 weeks only when the market can probably fall by more than 2% from the previous week close. But right now, what we are talking is not 2%, because 15,500 to 15,700 is 200 points, which is something like 1.5%. It's not 2%, because the volatility is like that. If you really go with the 2%, then it will come to 15,400. It will come closer to 15,400. But the volatility is such that no, we will not get much of a premium of 15,400. So we have just opted for a 15,500, 15,300. So this particular trade now with this is going to be considerably what I would say a type of a winner type of trade consistently over a period of time. It is going to help you win consistently over a period of time, producing as many winning trades as possible. We have back tested also. Now we have seen the last, of course, we have back tested from 2015, and in the last 7 to 8 weeks also, there has been consistent profits where we are getting something 1,700, 1,800, 1,500, 2,100 rupees per week. We are getting that. So if you do for 3-4 weeks also, then 4 weeks in a month, if there is no loss, you will get there's a good chance that you may get some 5,000, 6,000 rupees or more than that. And for an investment which is only 25,000 rupees, which is an investment which is only 25,000 rupees is right now is what is required. For a 25,000 rupees, you may easily get, as I told you, 1,250, 1,300 rupees per week, which probably could give you something like 5,000 rupees per month, and which is a good amount of return in case if you don't make a loss. But I told you that in case some weeks probably there is a chance that you may make a loss, and we have accepted that loss. We have just been passive. We are not doing anything. Okay, but come a situation where probably we will also look at what time probably we can move this position or do something about it. Right now we are not doing anything like moving the position back forth, involving cost. No, we are not doing anything like that. But in future, if it happens, we will tell you what exactly needs to be done in order to recoup that. That will come later. Right now, you can just accept that if you do even a very, very passive investment, very, very passive type of trade, just do a simple put spread. And the put spread should be in such a way that it should be done on a weekly basis. You just do at 3:15 p.m. on Thursday. At 3:15 p.m. on Thursday, look at the spot at that point of time. Whatever the spot which is near and the strike which is closer to that, look at the average of call and put option premium. That particular thing into two. There is call option price, there is average of call and put option, or you add the call and put option price together, okay, and deduct it from the nearest strike. Suppose you have 15,680, take 15,700 call and put, add the call and put price, subtract that from 15,700. You will get some rate which will be closer to 15,500 or so. So just go and sell a 15,500 put, and then buy a 15,300 put as a thing for as a stopgap. Now the chart will give you some confidence also. Now when we are talking about it, this one, see. Now, I told this is see, this was today. If you look at like a weekly option, let us say today, Friday being close. Let's look at the last Friday. Last Friday, the market was 15,860. Okay, it was 15,860 last Friday. Okay, and right. So there was on 25th June. Now today it closed at 15,722. Now going by the present volatility scenario, the volatility scenario now is talking about the market not going much below 200 points from the previous close, that is 15,860. So 15,860, 15,660. Okay. So the close has to be above 15,660. So whenever there is a dip below 15,660 itself, you could have bought. And today, if you see, the close is above 15,722. Right. So even if you have done a trade on that day, 15,860, and you have sold a 15,650 put, you would have sold. Okay. Today you would have been a little bit nervous, but just see at the last minute, it just recovered to close beautifully well, like 15,722. It just recovered there. So suppose if you look at this trade also next day, see this particular day, it was 15,814. So what is the likely thing for tomorrow? If you look at it, 1, 2, 3, 4 on Monday. So when the market was behaving today at 15,630, 640 itself, it could have given you a feeling that probably it is 15,814 minus 200 points, so 15,614. So you don't expect the market to close much. So you expect the market to be on Monday close to be more than 15,615. 15,615. You expect the market to close above 15,615. And so when the dip was taking place towards 15,630 or 640, right? So that means it would have given you 15,636. So you could have probably bought also today, because you know that tomorrow 15,630 to 50 when it is there, the chances that on Monday the close is not going to be much below 15,615 could have prompted you to enter into either a cash market trade or a futures trade, right? So that is what we are seeing here. But sometimes always there is an exception. So in that particular case, we could have gone for a call option, like probably which could have removed it on Monday or so. So you could have gone in for a call option also today for next day expiry, just buying, because you got at such a low level. So this is how you make your planning. Now let us say let us look at some other day also. See this day 15,746, right? So in this, from there, 5 days from here, now if you look at it, this is 15,746. 5 days from there, you don't expect the market to be more than 15,946. So if you look at it, 1, 2, 3, 4, 5. So the market on this day was 15,915. So that day, the chances that on the close above 15,945 is not going to happen much. So you could have looked towards some sort of, looking towards some sort of an indicator which can help you to go for a sell, because it's very clear that the chances that it can close above 15,945 is going to be quite remote. So it could have given you a great amount of confidence to do the trade. Now even if you look at it, now the option prices have come down so significantly that we expect that on a month-on-month basis, based on the present option prices, 450 to 500 rupees is the possibility on a month-to-month basis itself. So if you look at any particular day, let us say this was second thing, it was 15,576. So this was 2nd of July. So if you had asked at what 2nd of July where maximum it could have gone, we could have replied that probably not about 16,070, 75 or so. So when it was expect coming very closer to the 15,915, probably there's a chance that you can even plan for some sort of a selling for the next 1 week or so. So what I'm trying to say is that whatever the option premium, generally speaking, whatever the option premium, that into 2 in general circumstances, market will not penetrate that easily. Only 15% of the time it will penetrate. In order to take care of that 15%, we are just putting a buy side also. That is, on the buy side also we are putting thing in order to take care of ourselves for any eventuality. Now, why we are not doing generally the call side right now is that first of all, we want to be a buyer. Okay, somebody has also has asked a question also, that is, why are we only looking at the, I think there is a question, it has to be done only in put. Okay, so somebody has asked whether we should do only in terms of put. The reason I told you, the reason why we are going for a put is that put selling is like a futures buying or is like a cash market buying. So we are in line with the trend. The overall trend is the market is up. So for the market to be up, either you have to be a buyer in the market or you have to sell put. So that is what we have done. So that is why we have gone for a sell put. Now sell call also you can do, but the same thing which I told you, into 2 times of the option price. 2 times of the option price. All those things you can definitely attempt and do that. But since the market generally slightly on the when it goes on the upside, you get a bit nervous. Okay, so generally the market tries to go on the upside more frequently than on the downside. Downside, limited period but shock effect. Suddenly it will fall and then rise. The general push and overall trend is on the upside, so it will keep on scaring you. It will keep on scaring you that particular level is coming closer, that level is coming closer. What should you do? What should you do? So that sort of inkling will be there. That is the reason why we have avoided the sell side, because instead of doing a sell side call, you can do the sell side put, right? Or if you want to add one more contract, you can add it on the sell side of the put itself. That is the reason why we have chosen this. Now we will explain this as far as Bank Nifty also is concerned in coming week. But right now I told you that this week, Thursday, yesterday, we have taken a 15,500 put sell and 15,300 put buy, and approximately is around 25 rupees or so. We will see what happens. So we are not scared about if there is going to be a fall, because 15,300 there is a protection. Second thing, if it comes below 15,300, chances that you will again go back to some level, higher level. That time you will just buy a futures or we will do something. So what is there to be scared? So we should definitely attempt this particular trade, which will give you a return on investment very much. So now because of certain difficulties, we could not use the straight away. So we had to struggle to use in the Microsoft Word. So next week it will be ready, and next week we will see again and again we will repeat the type of structure that we attempt to do. On every Friday we will tell you what we did on Thursday, and so that you will also get a confidence and do this these type of trades. So now you can ask your questions now. So hope this session was productive, and looking forward for your feedback, and probably I will be very happy that if you post questions in future also, and we will definitely be there to help you out in this particular strategy, and we welcome you to do the strategy which will give you a lot of confidence. Okay, thank you very much, and stay safe and happy weekend. Thank you very much. Bye.